Thank you for the introduction. It's certainly a pleasure to be part of this year's New South Wales Farmers Conference, and I look forward to hearing some of the policy debates that are lined up for later this morning. For my contribution today, I've been asked to provide a reasonably short economist's presentation. Now, for me, it's the short presentations that provide the biggest challenge, as there are so many potential topics that I would like to cover. However, in the interest of keeping today's program running close to schedule, I've tried to be pretty selective in what I'm covering. So I thought it would be prudent to start with touching on some of the rural commodity trends before moving on to more macro-related themes around the Aussie dollar and interest rates. Now, unfortunately, our specialist agri-economist was unable to attend the function today, but if any of you would like to see some of the great work that he does, I invite you to visit our website and check out some of his freely available analysis, as well as some of our other economic commentary as well. Now, even with the time constraint I'm facing this morning, at the end of the day, I am still a bank employee. So deep down, I know none of you thought I'd get through an entire presentation without showing one of these. So I might as well get it out of the way up front. Essentially, it's a pretty standard disclosure, noting that none of the material provided in the presentation today has been prepared based on your specific circumstances, so is not intended to be treated as financial advice. So please keep that in mind. Now, with that out of the way, this first slide of charts demonstrates the recent performance of key agricultural commodities, commodity prices in Australia. The NAB Rural Commodity Index, or Price Index, is an index of 28 agricultural commodities, weighted by the relative size of each commodity in the Australian agricultural sector. Overall, the index was unchanged in June, as decent dairy auction results and much better grain prices were offset by generally poorer livestock prices and weakness in sugar and cotton. Higher grain prices have come off the back of dry US weather and concerns around Australia's supplies given the relatively dry start to the winter. In terms of New South Wales more specifically, we have constructed state-based price indicators to reflect the particular composition of each state's rural commodities. In June, the aggregate New South Wales index was up just 0.2%, although we have seen a clear upward trend in the index since the end of last year, driven by support from much higher grain prices, lamb and wool prices. Following these trends down to the regional level, which has been demonstrated in the heat maps on this slide, it's no surprise that the grain-growing regions in central western New South Wales have performed particularly well, although most producing regions across New South Wales have generally seen higher prices over the past year. That said, there is an emerging weakness in livestock-heavy regions, especially in cattle areas across Australia, and even when it comes to grain regions, even though prices are looking good, yields are unlikely to be as crash hot, which could be a problem depending on whether climate conditions remain dry. Young cattle prices have trended downwards recently amid dry weather and mixed export markets. The Eastern Young Cattle Index is now below its level at the same time last year, which is the first time that's happened since 2014. Dry conditions have seen slaughter rates increase, according to data from Meat and Livestock Australia. And if winter dryness persists into spring, it is likely that there will be further turn-off and increased pressure on sale yard prices. It has been our view for some time, though, that the extraordinary cattle boom that we have seen in Australia over the past 2 years largely reflects several one-off factors that were unlikely to be repeated. In terms of the outlook, though, naturally much of that comes down to expectations for weather and the Australian dollar. Drier weather is already denting cattle and lamb prices, and if these conditions continue, we can expect to see some further downside, especially for cattle. The Bureau of Meteorology's 3-month outlooks have been forecasting well below average rainfall for South Australia for most of 2017. Now, while actual rainfall levels have generally outperformed those official forecasts through the autumn, winter is looking much drier so far. The Bureau of Meteorology's 3-month climate outlook for till September showed below average rainfall expected in the Western Australian wheat belt, as well as southwest Australia, covering much of Victoria and New South Wales, as well as parts of South Australia. If these rainfall levels transpire, there is a potential downside risk for grain yields and spring pastures for livestock. Now, we recently released our initial wheat production forecasts, coming in at 23.3 million tonnes for this season, which is well down on the bumper crop we saw last season. But if it stays dry, we expect further downside risk to that outlook. Dairy production could come under pressure as well if pasture growth is below expectation or below average. Conversely, I've already noted that dry conditions have seen an uptick in cattle slaughter, and if the dry conditions do continue, production is likely to be higher for some months before coming off again. The outlook for prices over the coming year will also be highly dependent on the track for the Aussie dollar. Over the past few years, the Aussie dollar has been hugely volatile, dropping like a stone between early 2013 and late 2015, which did help contribute to the recovery in rural commodity prices denominated in Aussie dollars. Since that time, we've seen it stabilise around the mid-75 US cent level. The outlook for the currency is largely dependent on what we see in the United States, as increases in the Fed funds rate are expected to put downward pressure on most commodities, including the Aussie dollar, which we expect to dip down to 70 US cents by the start of 2018. So that will provide some upside support for prices, but we do see the 70 cent mark as the low point for the Aussie dollar, with the currency to remain around that level well into 2018. Recent trends could also suggest some upside risk to the Aussie dollar in the near term, which could put additional unexpected pressure on commodity prices. The Aussie dollar has pushed back up to around 79 US cents recently, receiving a bit of an extra boost in the last couple of days from commentary coming out of the RBA, as well as some very strong economic data out of China, which has given a bit of a leg up to hard commodity prices. There have also been some misses in terms of the US economic data of late that hasn't helped either. Now, while we don't expect the Aussie dollar to stay at these levels, it will be interesting to see how the RBA reacts if it does, especially given the frequent comments that they've made around the fact that an elevated Aussie dollar would complicate the economic transition that is currently underway in the wake of the mining boom. Unfortunately, I suspect I've only got probably a couple of minutes left, but in the time remaining, I did want to touch more on our view of the RBA cash rate, given the implications for financing costs. So this chart here shows what the market is pricing in for the cash rate compared to NAB's forecast. While there is very little chance of a rate hike in the near term, financial markets have fully priced in a 25 basis point hike before the end of 2018. That largely reflects indications from the RBA that it remains confident that the economic outlook or economic growth will lift materially in the next 1 to 2 years, despite any near-term volatility in the data. Now, we are certainly seeing some justification for that view in the data, particularly when it comes to the business sector. Profits have been on the rise, and responses to NAB's business survey, which is one of the longest running surveys of its type in Australia, and it's one that's closely watched by both the RBA and various levels of government, is showing the business conditions, which is essentially a composite of things like sales, profitability and labour demand, are at their highest levels since before the global financial crisis. Business confidence is also at levels well above the long-run average, which is encouraging in terms of the implications for hiring intentions and business investment. Indeed, labour demand has been on the rise, and the most recent figures from the Australian Bureau of Statistics showed bumper job creation of nearly 150,000 jobs in just the last few months. At the same time, the NAB survey is pointing to monthly job creation of around 20,000 jobs per month in coming months, which should be enough to push the unemployment rate lower. However, the puzzle for many is why wages growth has remained so muted despite the stellar employment growth. To us, part of the answer lies in the significant structural headwinds to the labour market, which includes the loss of high-paying mining jobs, as well as the casualisation of the workforce, which is evident by high levels of reported underemployment, which is essentially people wanting to work more hours but can't. These headwinds are likely to persist for some time and are contributing to the poor state of the household sector, which in our view really puts a spanner in the works for the prospects of any near-term rate hikes. In particular, we've continued to see relatively lacklustre spending from households, which is a concern given that private consumption accounts for more than half of Australia's gross domestic product. Consumer confidence has taken a beating in recent years and isn't showing much sign of a recovery. The chart on the left-hand side of this slide shows just how big the disparity in confidence between households and the business sector has become. And while the chart on the right-hand side looks a little complex, it is simply telling us that poor confidence is having a notable impact on spending behaviours, as households prefer to focus most of their spending on buying essentials and, importantly, paying down debt, which, as you can see from this chart, has hit record levels on the back of the housing market boom in Australia. Add to all that the fact that we expect the housing construction boom will soon peak and property prices now look like they're starting to come off the boil, you're left with a very mixed bag in terms of the economic outlook. Overall, our outlook for growth is a little less sanguine than the likes of the RBA. In addition, with underemployment pointing to continued slack in the labour market, we don't see weak wages and inflation data turning around anytime soon. Meanwhile, there is tentative evidence that other policy measures, such as regulatory imposed limitations on investor credit, are leading to a bit of a softening in dwelling prices, which may help to dampen some of the RBA's concerns around the financial risks at the moment. The bottom line then is that the RBA should be in no hurry to raise rates anytime soon, and our forecast is that that's not likely to happen until around mid-2019. Now, I've probably gone over my 10 minutes, so I may need to keep it there, but thank you very much for your time.